Hey everyone, welcome back to Conviction Bet. Hope you're doing well. The Dow opened the week with another record close, and then the chip complex wobbled hard on Tuesday, so we've had a little of everything already. Second quarter earnings season kicks off in earnest next week when the big banks report and expectations are running hot. Analysts are penciling in more than 20% earnings growth for the quarter, so enjoy the calm while it lasts. And speaking of expectations, Samsung posted a record $58 billion of quarterly operating profit this week, 19 times last year's number, comfortably ahead of consensus, and the stock fell anyway because investors had already priced in something even better and started wondering whether the memory boom just peaked. 2026, where a record-breaking beat is a sell signal. But here's what actually matters this week. On Monday, as the market closed, funds tracking the NASDAQ 100 lined up to buy an estimated $4 billion of SpaceX stock. Nobody at those funds decided SpaceX was worth owning. No analyst memo, no valuation debate. They chose how to execute, never whether to own it. A rulebook told them to buy, and so they bought. The market is telling a story about Elon Musk and the biggest IPO in history. The real story is about the rulebooks, the documents that quietly decide what millions of people own and that almost nobody has ever read. I'm J.L. Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. The index industry has counted more than 3 million indexes in the world, and there aren't enough index funds on Earth to track even 1% of them. We're going to open up those rulers and look at the machinery inside. And along the way, I'll explain why the index provider that just turned away the hottest stock on Earth did its investors a favor. And by the end, I want to convince you of something slightly uncomfortable. The most important document in your portfolio is one you have never read. Let's start with a distinction that sounds pedantic and turns out to be everything. An index is not a fund. An index is a measurement. It's a ruler. You cannot invest in a ruler. The consumer price index is the same idea pointed at eggs and rent instead of stocks, a number that summarizes a basket so you can see whether the basket got more expensive. A stock index does exactly that for a basket of companies. The S&P 500 is not a product, it's a statistic. The thing you actually buy is an index fund, a vehicle built to track whatever the statistic contains. And the scale of the ruler business is genuinely absurd. The Index Industry Association has counted more than 3 million indexes worldwide, covering stocks, bonds, commodities, anything with a price. The World Bank counts roughly 43,000 listed companies. Your first instinct is probably that index funds explain the 3 million. And your first instinct is wrong. The world's index funds number in the thousands, not the millions, nowhere near enough to account for all those rulers. The industry association's own answer is that the predominant use of an index is benchmarking. Every active manager needs a yardstick to be judged against. And every strategy wants a yardstick shaped exactly like itself, so the yardstick factory never stops running. Most of those indexes will never have a single dollar tracking them, and that's fine. Most rulers exist to measure, not to be bought. That's the quiet, unglamorous job of an index. It's market infrastructure, the way survey markers are, land infrastructure, the measuring came first, and the investing was bolted on later. But some rulers attracted money, a lot of money. Bloomberg Intelligence puts the passive money tracking the S&P 500 alone at about $7.5 trillion, with another $3.4 trillion in active funds benchmarked against it. Passive funds passed active funds in total United States fund assets about 2 years ago, and the gap has only widened. And that happened because the scorekeeping is brutal. S&P has published an annual scorecard comparing active funds to its own indexes since 2002. And the latest edition, covering year-end 2025, is one of the ugliest on record for stock pickers. 79% of active large-cap United States equity funds underperformed the S&P 500 in 2025 alone, the fourth worst year in the scorecard's 25-year history. Stretch the window to 5 years, and 89% underperformed. Stretch it to 20 years, and 93% did. Those numbers already account for all the funds that died along the way, so there's no survivorship flattery in them. 93% over 20 years. That scoreboard is a big part of why trillions of dollars stopped paying people to guess and bought the ruler instead. But here's the thing you need to understand, and it's the premise of this whole episode. When you buy an index fund, you are not buying the market in some abstract sense. You are buying the output of a specific document, a methodology published by the index provider that spells out how stocks get in, how much of each you hold, when the basket changes, and where the provider keeps a measure of discretion. Two indexes with nearly identical names can be running completely different machinery underneath. So the investor implication of this first section is simple. Your real holding is not 500 stocks. Your real holding is a rulebook, and rulebooks, unlike fund managers, put their process in writing in advance for free. Now, let's open one of these rulebooks up because the machinery is far less intimidating than it looks. Here's how I want you to think about it. Imagine you're buying blueberries, not a handful, a full crate, and the market in front of you has every blueberry grown in the country. How do you fill the crate? You need rules. Maybe you sort by size and take only the big ones. Maybe you also taste test and throw out the bottom 20% by sourness. Maybe you insist on a mix of farms, so one region's bad season can't ruin your crate. Maybe you demand a pedigree only berries from bushes that have produced reliably for 25 straight years. Every one of those choices is defensible, and every one of them fills the crate with different fruit. That, in one image, is index construction. Every equity index methodology is answering the same 5 questions. 1. What's the universe? Which markets are we even shopping in? 2. How do we sort by company size for the broad benchmarks, by dividends or volatility or any other measurable trait for the specialty crates? 3. What do we screen out? Usually the stocks that are too hard to trade, the sour berries of the market, plus sometimes profitability or sector requirements. 4. How do we weight what's left by size, equally by dividend yield? And 5. When and how do we rerun the whole process, the rebalance? 5 levers. That's the chassis of the machine. The fine print adds gears, buffer rules, caps, and sometimes committee discretion. But those 5 explain most of what you actually own. And small differences in those levers produce wildly different crates, even under nearly identical labels. Take the cleanest possible example. The S&P 500 and the S&P 500 equal weight. Same 500 companies. Identical universe, identical screens. The only lever that differs is number 4, weighting. One holds companies in proportion to their size. The other holds the same slice of each. In 2025, that single lever produced a gap you could drive a truck through. The cap-weighted index rode a technology sector that had grown to more than a third of its entire weight, 34% as of December, while the equal-weighted version, which resets every stock to roughly 0.5% at each rebalance, so no handful of giants can dominate, lagged badly for most of the year. Only 30% of the stocks inside the S&P 500 actually beat the index itself in 2025. The average stock lost to the basket it was standing in because the basket was leaning so hard on its giants. Same berries, different crate. And lever 2, the size sort, mattered just as much last year. In 2025, the S&P 500 beat its own sibling, the mid-cap 400, by 10 percentage points and beat the small-cap 600 by 12. Third consecutive year, the big crate won, which produces my favorite piece of fine print in this whole subject. A year earlier, small-cap fund managers posted their best scorecard result on record, and S&P's researchers traced most of it to managers quietly tilting their supposedly small-cap portfolios toward bigger stocks. They didn't outpick the markets. They outdrifted their own label. And this is exactly why finer rulers exist. Once you can measure a manager against a size index, a sector index, a style index, the question sharpens from, did you beat the market, to, did you do anything a cheap rulebook couldn't have done for you? A fund manager who beat the S&P 500 by loading up on technology didn't by that alone, demonstrates skill worth paying active fees for. They demonstrated a sector weight. You could have bought through a sector index fund for about 0.1% a year. The indexes keep raising the bar for what counts as skill. Or compare across providers. The Russell 1000 is mostly mechanics rank United States companies by size, layer on float and housekeeping rules, take the top 1,000. The S&P 500 adds judgment and gates, a committee, a profitability requirement, a minimum trading history. The NASDAQ 100 only shops at one store, the biggest non-financial companies listed on the NASDAQ exchange, which is why it behaves like a technology index without ever saying the word technology. And the Dow Jones Industrial Average is a lovable antique that weights companies by share price, which is why a stock split changes its influence in the index while changing nothing about the business. All four get described in headlines as the market. They are 4 different crates filled by 4 different sets of hands. And once you can read the 5 levers, the exotic-sounding products stop being exotic. The Dividend Aristocrats Index is just the pedigree rule from our blueberry stand. S&P 500 members that have raised their dividend every single year for at least 25 consecutive years, held in equal weights. 69 companies qualify as of this year's January rebalance, a record out of 500. The rule is merciless, by the way. You don't need to cut your dividend to get expelled. Merely freezing it for 1 year breaks the streak. 3M lost its aristocrat status in 2024 after trimming the payout around a spinoff, and a quarter century of pedigree evaporated. So here's the takeaway from this section, stated as plainly as I can. Before you buy any index fund, find the methodology document and check the 5 levers universe: sort, screens, weighting, rebalance. Because that 20-minute read tells you more about your future returns than any amount of scrolling through performance charts. But that's only half the story. Because the part of the machine that makes investors genuinely nervous isn't the sorting, it's lever 5, the rebalance. The moment the machine trades, the anxiety goes like this. Indexes add stocks after they've already gone up. That's how they got big enough to qualify and delete stocks after they've already gone down. So isn't a rules-based index just a machine for buying high and selling low, a device that forces the passive investor to chase? Before we look at the evidence, notice what that worry quietly assumes. It assumes, first, that somebody could have timed those entries better, again and again. The scorecard we just walked through doesn't test that question directly, but it tells you how rarely paid professionals manage to turn exactly that kind of judgment into lasting outperformance after costs. And it assumes, second, that whatever has gone up must come back down, that a stock entering the index near a high is automatically entering at a top. But mean reversion is a tendency, not a law. Declaring a new entrant too expensive to add is itself an active bet, and it's precisely the bet the market can't agree on. A deep value investor looks at that price and sees mania. A growth investor looks at the same price and sees a discount to the future. The index refuses to referee that argument. It holds no opinion about price. A committee may guard the eligibility gates. We'll get to exactly that. And yes, value indexes exist that screen on price by rule, but that's just a different rule book. The moment the valuation calls become case-by-case judgment instead of written rules, you're no longer holding an index. You're holding a manager. It's a fair worry, and the best way to examine it is the most extreme case on record. Tesla, December 2020. S&P announced in mid-November of 2020 that Tesla would join the 500, and the stock jumped nearly 40% in the 2 weeks after the announcement alone, on top of a year-to-date gain that was approaching 600%. Frontrunners bought because the index funds would have to buy. At the time, more than $11 trillion was benchmarked to the S&P 500, with roughly $4.6 trillion of it in index funds. Goldman Sachs estimated $8 billion of demand just from active large cap funds before you even counted the passive wall. Tesla kept climbing right into the effective date, closed at a record high the Friday before inclusion, entered the index at more than 180 times forward earnings, one of the most expensive companies ever to join, and then fell 6.5% on its very first day inside. Every part of the critique is visible in that story. Researchers at Research Affiliates have documented the pattern across decades. About 23 stocks enter and 23 leave the S&P 500 in an average year, and roughly two-thirds of additions rally between the announcement and the effective date. The machine really does tend to buy things on the way up, but now watch what happened next, because this is where the anxiety falls apart. Tesla rose sharply through 2021, then fell roughly 65% in 2022, then staged another enormous recovery after that. None of it, not one leg of that ride, was driven by the index. It was the company, the delivery numbers, the interest rate cycle, and the crowd. The rebalance was a single splash. The tide was the business. And the splash itself has been shrinking. Two Harvard researchers, Robin Greenwood and Marco Salmon, studied every S&P 500 addition and deletion going back to 1980, and their finding is right there in the paper's title, The Disappearing Index Effect. In the final decade of their sample, 2010 through 2020, the average pop for added stocks had faded to roughly zero, statistically indistinguishable from no effect at all, precisely because everyone learned about it and arbitrage ate it. A high-profile name can still jump on its announcement day, Tesla did, but the systematic free lunch across additions is gone. Markets are rude like that. The moment a free lunch gets documented, it gets eaten. Here's what I would offer. Anyone who still worries the index bought their exposure at the top. Think about where index returns actually come from over time. O'Shaughnessy Asset Management once decomposed the S&P 500's, roughly 9.85% annualized total return measured across more than half a century. About 6.3 percentage points came from the growth of the underlying businesses. About 3.1 came from dividends. And less than half a point came from valuation multiples expanding. S&P's own long-run data tells the same story from another angle. Dividends alone have supplied roughly 31% of the index's total return since 1926. Now, that decomposition doesn't price the rebalance moments directly. The Harvard study is the evidence on that, but it tells you what league those moments play in. Over decades, the game is won on what the companies earn and pay out, not on the timing of the day they entered the basket. And meanwhile, the rebalance is quietly doing something valuable that the critics rarely credit. It's the index's metabolism. In 1995, the top of the S&P 500 belonged to names like General Electric, Exxon, and Coca-Cola. Today, it's an entirely different set of giants, and the index never needed anyone's permission or anyone's foresight to make the switch. Companies can climb a ladder from the S&P small cap 600 to the mid cap 400 to the 500, and they climb it by growing. In 2024, the Dow, the rare index still picked by a committee, swapped Intel out for NVIDIA, one era handing the baton to the next. A basket that never updated its membership would still be carrying its 1995 roster, waiting for bankruptcies and buyouts to do its pruning for it. The occasional awkward purchase near a high is the fee you pay for a portfolio that never fossilizes. So the investor takeaway for this movement: stop watching what the index buys at the rebalance and start watching what the businesses inside it earn afterward. Because over any horizon that matters, the second number is the one that pays you. Now let's walk into the aisle of the market where the fruit looks sweetest and the traps are thickest. Dividend indexes. With yields on cash and bonds down from their peaks, dividend strategies are having another moment. And the pitch writes itself. The S&P 500 yields barely 1%. While dividend-focused indexes commonly yield 3 or 4, why wouldn't you take the bigger number? Because a dividend yield is a fraction, and fractions have two ends. Yield equals dividend divided by price. A stock paying $1 at a $20 price yields 5%. Let the price get cut in half while the dividend limps along unchanged, and congratulations, it now yields 10%. The yield doubled because the business got worse. That's the dividend trap. And in the blueberry market, it's the crate of premium berries selling at half price. The discount is not a gift. The discount is information. Something is going soft in that crate, and the sticker just hasn't caught up. So the question for any dividend index is never how high is the yield. It's what does the rulebook do to filter out the traps? And once you know to look, you'll find the filters sitting right there in the methodology, each one a different answer to the same problem. The Dividend Aristocrats answer is time. 25 consecutive years of increases is a filter almost no broken business can fake, which is why only 69 companies pass it. And watch what that one pedigree rule does to the flavor of the crate. The Aristocrats hold roughly 3% in technology against more than a third for the S&P 500, and they're stuffed instead with consumer staples and industrials, the boring, cash-spinning businesses that can raise a payout through anything. Their average yield runs about 2.5% against the parent index's 1. And when the S&P 500 fell roughly 18% in 2022, the Aristocrats beat it by more than 10 percentage points. Same starting universe of 500 companies. 2 changes in the rulebook, the 25-year screen, and equal weights. A completely different animal. Another popular answer is volatility. The S&P 500 Low Volatility High Dividend Index, the one behind Invesco's popular high dividend fund, takes the 75 highest yielding stocks in the 500, then keeps only the 50 with the lowest realized volatility over the past year. Think about why that works. A yield that got inflated by a collapsing price usually carries the scars of that collapse in its volatility. Screening out the wildest movers quietly screens out the fake yields. But now read the label carefully, because this is where investors get hurt. Low volatility in that index name is a relative term, not a promise. It means the calmest 50 out of a pool of 75 high yielders. It does not mean calm. These are still stocks. In a real drawdown, they still behave like stocks. Remember what beat the market by 10 points meant in 2022? It still meant a down year. Outperformed, as in fell meaningfully less, not as in went up. And the insurance has a premium. Over the 5 years through late May, the Invesco fund tracking that strategy returned about 36% in total, while the main S&P 500 fund returned about 92%. Dividends reinvested in both. Smoother ride, roughly half the destination. That's not a scandal, it's the trade-off, printed in advance in the rulebook. 2 more habits worth stealing before we leave this aisle. First, prefer dividend indexes that hold at least 50 to 100 names drawn from larger companies with too few holdings. One value trap can poison the crate, and a microcap dividend index is mostly a bet on microcaps wearing a dividend costume. Second, when a fund advertises a fat distribution, distinguish the check it writes from the dividends its holdings actually earn. Certain closed-end and managed payout funds can top up the check by handing you back a slice of your own capital. The berries aren't sweeter. The vendor is scooping some out of your crate, putting them back on top, and charging you for the presentation. A plain dividend index fund passes through what its companies actually pay, which is exactly why the rulebook behind it is the thing worth reading. The takeaway here is one sentence. Never buy a yield number. Buy the rule that produced it, and make sure that rule has a working trap filter. And this is where most people stop reading, because everything so far treats the rulebook as settled scenery. The last movement is about what happens when the biggest IPO in history walks up to the rulebook and asks it to bend. The surface story. SpaceX went public on June 12th, priced at $135, raised about $75 billion, targeted a valuation around $1.75 trillion, the largest offering ever. Instantly, one of the most valuable listed companies in America. Musk rewrote the IPO playbook on the way in, carving out roughly 30% of the deal for retail investors through the big brokerages, an enormous direct retail slice in a business where the traditional offering hands the overwhelming majority to institutions. The kind of company, in other words, that every benchmark supposedly exists to represent. There was just one problem. Under the rulebooks as they stood on IPO day, SpaceX qualified for almost nothing. The S&P 500 requires a company to be profitable under standard accounting rules in its latest quarter and across its trailing 4 quarters combined. SpaceX lost $4.94 billion in 2025. The 500 requires 12 months of trading history. SpaceX had 0. It requires at least 10% of shares floating and available to trade. SpaceX floated less than 5. So the index providers faced a genuine test, and here's the remarkable part. They split NASDAQ rewrote its rules to give the very largest new listings a fast entry lane. SpaceX made it into the NASDAQ 115 trading days, down from the old 3-month minimum. FTSE Russell went further still, fast entry after 5 trading days, which is exactly how this Tuesday, SpaceX landed in the NASDAQ 100 at a starting weight of roughly 1.3% by JP Morgan's estimate, a weight NASDAQ's new rules boosted by counting SpaceX's sliver of tradable shares at 3 times its value, with an estimated $4 billion of automatic buying at Monday's close, and every other name's weight shaved back to make room. Nobody was even deleted to make space. The index is simply running with more than 100 names for a while, dryly. The 100, featuring for now more than 100. And S&P? On June 4th, after a formal public consultation in which it explicitly considered cutting the 12-month seasoning requirement in half and relaxing the float rule, S&P Dow Jones indices announced it would change nothing for its flagship. No exceptions to the profitability, seasoning, or float requirements based on size alone. In its statement, it said the decision preserves core index principles. And here's the detail that proves this was principle rather than stubbornness. In the very same decision, S&P did adjust the float rules for its broadest total market indexes, the ones whose stated job is to capture everything. A total market ruler that misses a $2 trillion company is failing at its own objective. So the rule moved. The 500's objective, representative, and investable with quality gates was already being met, so its rule held. Rulebooks do evolve. They evolve through public consultation in service of the index's stated purpose, not because a founder is impatient. Translation: the biggest IPO in history cannot even be considered for the S&P 500 until at least mid-2027, and only then if it starts earning actual profits. And even then, eligibility just gets you to the committee's door. The same wall now stands in front of OpenAI and Anthropic whenever they list. So why would S&P leave that on the table? Bloomberg Intelligence estimated that fast-track inclusion would have generated roughly $14 billion of forced passive buying in SpaceX, a $14 billion favor to the most powerful person in markets declined in a press release. Because the committee that writes the rulebook is deliberately walled off from the business that sells it, the people deciding what enters the index are firewalled from the people who profit from licensing it, precisely so that a client, a banker, or a founder cannot lobby a stock into a benchmark. Bloomberg's ETF analyst Eric Balchunas put the stakes plainly. We'll see whether it turns out to be a wise choice. If SpaceX soars from here, S&P eats criticism for making its investors miss it. If it stumbles, the rulebook looks brilliant. But notice, S&P chose not to know. It chose the rule over the forecast. And a strategist at B. Riley Wealth said the quiet part out loud, holding the line on profitability, is exactly what the index's credibility is made of. Even classification runs on rules rather than stories, by the way. When SpaceX eventually knocks on more doors, the global industry classification standard, 11 sectors at the top, 163 sub-industries at the bottom, will file it not by the most exciting slide in its prospectus, but by a boring question. What is your principal business? Revenue is the main guide, with 60% as the usual threshold, and earnings and market perception breaking ties for the conglomerates. Rockets, satellites, artificial intelligence. The machine doesn't care which story is best. It cares which line item is biggest. And I know what the bear case is, the serious one, not the SpaceX gossip. It says, this entire episode proves the machine is dumb. A cap-weighted, rules-based index mechanically owns more of whatever has already gone up. It concentrated a third of itself in one sector by the end of 2025. And you showed us yourself that it buys additions after they've rallied. Rules without judgment means momentum without breaks. That is a legitimate concern. The buy-high pattern at rebalances is real and measured. And when the market overvalues a company, cap weighting hands it exactly as much weight as its inflated price commands. The index has no mechanism to correct the market's mistake. Nobody serious denies either point. But follow each thread to the end. The rebalance cost has been arbitraged towards zero. That's the disappearing index effect measured across 4 decades. The concentration isn't a bet the index made, it's a mirror of the market. It exists to represent the index doesn't believe in those giants, it reports them. And the alternative on offer isn't one thing, but two, one is paying a human to override the rules with judgment. The thing S&P's own scorecard has clocked at a 93% failure rate over 20 years. The other is choosing a different set of rules: equal weighting, dividend screens, valuation screens, factor tilts, concentration caps. And notice what that second alternative actually is: another methodology document. If you dislike this rulebook, the remedy isn't abandoning rulebooks. It's reading a different one, which has been the point of this entire episode. The machine is dumb the way a metronome is dumb. That is the entire product. The moment it starts forming opinions, not rules, opinions about which stocks are too expensive to include, you're back to owning a fund manager. And we have 25 years of data on how that goes. Let's bring this all the way back. An index is a referee, not a player. It doesn't try to win the game. It makes the game legible. It isn't trying to sell you the top or buy you the bottom. And if you expect it to defend you in a bear market, you've misread the job description. Its job is to hand you the return of the market it measures, minus a sliver of fees, for as long as you care to hold it. And the whole contraption, the trillions tracking it, the retirement accounts riding on it, rests on a stack of documents that spell out the sorting rules for the crate: what gets in, what gets weighted, what gets thrown out, and what happens when the most famous company on earth asks for an exception and is told politely no. You are not buying blueberries. You never were. You are buying the sorting rule. Pause. So read the rule. It's public. It's free. It's maybe 20 pages. And it is the rare document in investing that tells you in advance and in writing what it will do with your money. Rules, discretion, and all. Anyway, that's this week. If you're enjoying Conviction Bet, subscribe wherever you get your podcasts: Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm J.L. Maurer. This has been Conviction Bet.